Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, March 20th. The Fed handled this week's meeting quite well, frankly, calming investors' nerves while tempering the White House's erratic policies and their market impact. So stocks, bonds, and the US dollar gained yesterday. But how long the Fed injected optimism will survive is yet to be seen. So few US investors breathed a sigh of relief yesterday after the Fed decision. The Federal Reserve kept its policy rates unchanged as expected by analysts. It cut its growth forecast and lifted its inflation forecast quite notably. But the Chair Jerome Powell stressed out that the potential impact of tariffs on inflation would be transitory, implying that the Federal Reserve could actually continue to ease its monetary policy to support growth. And more importantly, the Fed decided to reduce the pace of QT, quantitative tightening. So that's also a move that eases the tightening of the financial conditions in the US. And it is also a hint that the Fed will never ever go back to the levels in terms of its balance sheet that we saw before the pandemic ever again. So the markets cheered the Fed decision yesterday. The fact that the Fed elegantly downplayed the long-term impact of rising inflation expectations from the tariffs while cutting its growth forecast for the year from 2.1 to 1.7%, by the way, will certainly boosted the dovish expectations for the Fed. And the dot plot actually showed that the Fed officials continue to foresee 2 interest rate cuts on average this year as before, and activity on Fed funds futures now gives around 70% chance for the next rate cut from the Fed to land in June. So the US 2-year yield slipped below the 4% level yesterday after the Fed decision. The US 10-year yield is below the 4.25% level. The S&P 500 jumped more than 1%. The Nasdaq 100 gained 1.30%. The Dow Jones Industrial Index recovered 0.93%. The mid-cap stocks jumped 1.26%, while the Russell 2000 Index led gains with a more than 1.5% rebound on relief that the Fed, though cautious, is not planning to deviate from its rate cutting and policy easing plans, at least for now, as again, the inflation peak that is expected to come with tariffs would be transitory. Now note that the Bank of America gave its latest monthly fund manager survey the title of bull crash. So a crash that comes from a sharp decline in growth expectations. It actually went so sharply down that the once bulls actually liquidated their positions, and they are now sitting on quite a big pile of cash that should one day go back to work, go back to the markets. Yet, whether the still highly valued US equities, especially the big technology companies, are the next destination or the safer bond investments would be preferred is yet to be seen. I guess the time will tell. And in the FX markets, well, the US dollar index rebounded on the back of a dovish and supportive Fed stance yesterday. Now, it's important to note that up until recently, the dovish central bank expectations would have a weakening effect on currency valuations as lower yields reduce the natural attractiveness of a currency. But, right now, the currency pricing and the currency valuations are more influenced by growth expectations. Therefore, a more dovish stance from the Federal Reserve increases the growth expectations for the US economy, tempers the recession odds, and this is exactly why we saw the US dollar rebound yesterday after a dovish Federal Reserve announcement. And I think it's a very important shift in market sentiment and the way market is pricing currencies. So the euro dollar is below the 109 mark yesterday. Inflation in the Eurozone came in lower than previously printed for February, mind you. Wages and labor costs in the Eurozone is in the fourth quarter of last year, and these are developments that brought the possibility of another interest rate cut from the European Central Bank before it pauses. But a pause looks more likely in the next ECB meeting due to these massive fiscal spending plans. But either way, the expectations of a stronger Eurozone economy remain supportive of the euro against the US dollar and sterling, although the euro's appreciation will likely slow as most of the optimism is already priced in. Elsewhere, while the dollar yen successfully pushed back against the 150 offers this week, and the pair is swiftly sold since yesterday after the BOJ decided to maintain its interest rates unchanged, citing the geopolitical and trade uncertainties. Now, here as well, not rushing toward policy normalization is supportive of growth expectations for Japan and its currency as a result of it, while cable keeps bumping its head against the 130 psychological resistance before the Bank of England decision that is due later today. Now, the Bank of England is expected to stay seated on its hands at today's monetary policy meeting. But the MPC's landscape is, quite not smooth, as 7 members out of 9 in the MPC will probably vote for a no change in the rates today, while 2 those are expected to favor a 50 basis point cut. Yet it clearly feels right now like the market is feeling more dovish than the BoE regarding the upcoming BoE meeting and decision and comments from there, given that the British growth numbers have taken a hit from the government's tax raising plans recently, while the rising gilt yields in the UK actually decreased the spending potential from the government. And the weakening potential for government spending increases the Bank of England's ability to support the British economy with a more supportive monetary policy, and that could eventually be positive for sterling. But yes, it is a bit stretch, I admit. So if sterling breaks the back of the 130 offers against the US dollar, it will probably be more due to a stronger depreciation of the US dollar across the board than a higher conviction for sterling. Now, last but not least, the Swiss National Bank here in Switzerland will also announce its latest policy verdict today, and the SNB will probably have announced a 25 basis point cut when this episode gets to you. Because the mounting geopolitical and trade tensions between the US and the rest of the world actually kept the neutral and the non-European Union member Switzerland quite out of the aggressive tariff talk, the big avenue of the aggressive tariff talk of the big boys. So the Swiss franc has been strengthening against the US dollar since the beginning of this year as other currencies, while losing value against the euro, its biggest trade partner. So this is the best of both worlds for Switzerland, as the stronger franc against the dollar keeps energy prices and inflation in check, while the softer franc against the euro somehow improves whatever is left from the competitiveness of Swiss companies against their European peers, but at least it does not further deteriorate it. So the Swiss SMI index gained almost 14% since the start of this year at some point, and the Swiss companies benefited big time from the rotation wins. And the high concentration of the defensive companies in the SMI index, like pharmaceuticals, for example, and consumer staples, actually placed and continues to place the Swiss companies and the SMI index in a good spot. Plus, the Swiss diplomatic relations with the Trump administration looks not too bad, at least for now. As such, the SMI index is probably set to continue to benefit from the rising appetite for defensive and value names, as well as a supportive Swiss National Bank policy that's also in favor of a softer Swiss franc and softer yields, which means that the interest rates in Switzerland will probably stay low as long as inflation in Switzerland remains in check. And you know what? Well, inflation in Switzerland is to 0.4% on a yearly basis. Yes, 0.4% on a yearly basis. So we maintain our preference for the Swiss stocks. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, and on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.